What if the wealthiest people in the world paid almost no taxes and it was perfectly legal? It's not a secret. It's a strategy called buy, borrow, die. And today, I'm going to break down how it works and how you can apply some of its principles to your own finances. The average person pays taxes on their income. The ultra-wealthy, they avoid taxes by using assets that appreciate in value, borrowing against those assets, and passing on their wealth to the next generation without paying taxes. Let's dive into how it works. Step 1. Buy assets that appreciate. The first step is simple. Buy assets that grow in value. Stocks, real estate, businesses. These are called appreciating assets. The key is, when these assets increase in value, you don't pay taxes on that growth as long as you don't sell them. For example, if you buy real estate for $100,000 and it's worth $1 million when you pass away, you're not taxed on the $900,000 gain because you never sold it. Instead, the value simply carries over to your heirs, and they inherit it at its current value. Here is a tip. Even if you're not a billionaire, start investing in appreciating assets like index funds or real estate. The goal is to accumulate wealth in assets that you can hold and let grow. Step 2. Borrow against your assets. Once you've built up assets, how do you access cash without selling them and triggering taxes? You borrow against them. When you borrow money, it's not considered taxable income, so you don't pay taxes on the funds you borrow. For instance, if you have a 10 million stock portfolio and need 3 million, you can borrow it from a bank using that portfolio as collateral. No taxes due. And while you borrow, you keep your assets working for you, still appreciating and earning returns. And remember, you don't need a $10 million portfolio to apply this. If you own property or have investments, you can use loans like home equity lines or margin loans to access cash without selling. This can still be very risky, of course. Step 3. Pass wealth without paying taxes. Now, what happens when you die? If you've held on to your assets, your heirs inherit them at their current market value, thanks to something called step-up in basis. This means they don't have to pay taxes on the gains you've built over time. For example, if you bought stocks for $100,000 and they're worth $1 million when you die, your heirs inherit them at $1 million. If they sell immediately, they pay no taxes on the $900,000 gain. If your estate exceeds $13 million single or $27 million married, there may be estate taxes, but most people won't reach those thresholds. Even so, there are ways to minimize estate taxes using trusts. And remember, you don't need to be a millionaire to benefit from smart estate planning. Start thinking about how to pass down your assets in a tax-efficient way, especially if your net worth grows over time. Conclusion. The buy, borrow, die strategy helps the ultra-wealthy grow their wealth, avoid taxes, and pass it on to the next generation with minimal tax consequences. Here's how it works. Step 1. Buy appreciating assets and hold on to them. Step 2. Borrow against those assets to access cash without paying taxes. Step 3. Die and pass your assets on to heirs with no tax burden on the gains thanks to the step-up in basis. While this strategy may seem reserved for the ultra-wealthy, you can start by applying similar principles to your own life. Invest in assets that appreciate over time, use debt strategically, and plan your estate carefully. The key takeaway: it's not about how much you make, it's about how much you keep. By investing in appreciating assets and being strategic about taxes, you can start building wealth today. Thanks for watching, and if you found this useful, don't forget to like, subscribe, and share. See you in the next video.